We're going to unpack the reality of home prices region by region. Then we'll analyze what's really driving mortgage rates. And finally, dig into some pretty bold economic predictions for 2026. It's not about the headlines, it's about what the cold, hard data actually shows you. So you can figure out what makes sense for you.
That's exactly right. And what's really critical in the sources we looked at is separating that national noise from your local reality. So we've basically broken this down into three main parts. First, we're mapping out, the geographic winners and losers in terms of current price moves. Second, we'll try to simplify the whole mortgage rate puzzle and the Fed's actual influence or lack thereof sometimes. And finally, we'll get into that forecast about the Fed's next big move, potentially a huge monetary easing cycle and what that really means for inflation and maybe a critical window for refinancing.
Okay, let's dive in. Starting with home prices. The number you keep seeing tossed around is that nationally prices are up, what, about 1.7% over the last year, which sounds, I don't know, pretty tame, right? Maybe even healthy. But if you just stop there, well, you've missed the whole story.
Precisely. That 1.7%, it's almost a statistical illusion, you could argue.
Yeah.
I mean, if prices drop 10% in Florida, but they shoot up 11.7% somewhere like Ohio, the average kind of hides that huge gap. Our sources really show how polarized the market is. Looking at the 300 biggest U.S. metro areas, get this, prices went up in 195 of them, but they actually fell in 105 markets.
Wow, okay, so it's a massive regional split. And if you picture the source material's bubble map, it makes total sense visually. You see these dark red bubbles where prices have fallen most. And they're heavily concentrated across the South, right? Especially places like Florida and then big parts of the West Coast, too. These were the spots that saw those absolutely wild price jumps during the pandemic boom.
hmm And then conversely, you see the darker blue areas. These are the markets showing more resilience, maybe even continued growth. And they're mostly clustered in the Midwest and the Northeast.
Hmm.
What's kind of fascinating, though, is that even with this cooling in some of those super hot markets, national home prices still managed to hit an all-time high earlier in 2025.
Really? Even with those drops?
Yeah. It suggests there's still some powerful underlying demand out there, even if it's, spread out really unevenly across the country.
So why do you think the Midwest and Northeast are holding up better? Is it migration, or maybe they just didn't have that same kind of speculative frenzy we saw in, say, Arizona or coastal Florida a couple years back?
It's probably a mix of things. Less crazy exuberance beforehand, maybe.
Uh-huh.
Plus, inventory is likely still pretty tight there. The price jumps in the South and West were just so extreme they weren't sustainable once interest rates started climbing. The Midwest and Northeast seem to have had slower, maybe more organic growth, makes them a bit more resilient. That single national number,
Yeah.
pretty much useless for your decision making.
Yeah, those regional differences are stark. But one thing connects all these markets: the cost of borrowing. So let's shift gears to mortgage rates. They have been coming down, which is good news. The average 30-year fix is now hovering near 6%.
Right, but we definitely need that context. I mean, 6% feels way better than when we were flirting with 8% back in late 2023. That's a noticeable improvement.
True.
However, you compare that to the sub 3% rates available just, 3 or 4 years ago, 6% still dramatically changes the affordability math for almost everyone.
Okay, so rates are falling because the Fed has eased its main rate, the Fed funds rate, a bit, and inflation seems to be cooling off compared to its peak, right? But let's get into the mechanics here, because this is where a lot of people get tripped up. I hear it all the time. The Fed cut rates, so my mortgage is going to drop like a rock. But that's not really how it works, is it?
No, and that's probably the most crucial technical point for listeners to grasp. The Federal Reserve does not directly control mortgage rates. Not at all. Their main tool, that Fed funds rate, mostly impacts really short-term stuff like overnight loans between banks, short-term government debt. Mortgage rates, on the other hand, they track much more closely with the interest rates on 10-year government debt. That's the key benchmark.
Ah, the 10-year Treasury. Okay.
Exactly. So when the Fed cuts its short-term rate, it can help nudge those longer-term rates down moderately, but it's not like flipping a switch. It's an indirect influence.
Yep.
Mortgage rates depend more on what the bond market thinks about the future economic growth, future inflation. So, we see a drop from 8% maybe down towards 6%, but getting them to really plummet, that takes more than just a Fed funds cut. You need those long-term yields to fall significantly.
Okay, that distinction is super important because it leads us right into the predictions for 2026. Our source material is suggesting the whole monetary tightening cycle is basically done. And the forecast points towards, well, continued interest rate cuts soon, followed by a major quantitative easing cycle, QE, kicking off sometime in 2026.
Right, QE. balance sheet expansion.
Let's talk about that. QE, sometimes called money printing or asset buying. Why are the sources predicting this heavy easing? And how is it different from the rate cuts we were just talking about?
Well, what's interesting and maybe a little concerning is that QE is kind of the Fed's big gun. It's how they directly influence those longer-term rates we just mentioned, unlike the Fed funds rate. This kind of massive easing, we're talking potentially trillions of dollars, usually gets triggered when there's some kind of systemic distress expected or maybe already happening. Think big bank bailouts, major problems in commercial real estate, maybe a nasty stock market downturn. Something needs rescuing.
Okay, so it's a response to trouble, basically.
Typically, yeah. And the source is predicting this easing could start maybe as early as Q1 or Q3 2026, with the really heavy stuff likely happening before Q4. Now, connecting this back, QE means the Fed starts actively buying up long-term assets, things like those 10-year government bonds we talked about, and mortgage-backed securities too. That huge buying pressure directly forces the interest rates on those specific assets down.
Ah, okay, so that's the direct manipulation. They're buying the very things that mortgage rates are tied to.
Exactly. That's the key difference. So the prediction is when the Fed starts doing that, starts expanding its balance sheet, mortgage rates should initially keep falling, potentially into the low fives, maybe even the upper fours for a bit.
And this is the actionable insight for you listening. If that happens, this drop creates a really critical but potentially very narrow window of time. We could be talking just a few months. That's your chance to refinance or maybe lock in a new purchase rate. If you're one of the many, many people stuck with a mortgage rate in the 6% or 7% range right now, this is the moment the sources say to watch for.
Absolutely. And the urgency here is key. Now, if you locked in a rate at 3% or even lower, you're golden. Don't worry about it. But for everyone else, that window is urgent because of the inflation lag. See, once the Fed starts essentially printing those trillions, it floods the system with money.
Okay.
But the effect on consumer prices, actual inflation showing up at the grocery store, that takes time.
Right. There's a delay.
A significant delay. And that's the catch-22. Because once that inflation does start spiking again, and the sources seem convinced it will, the bond market will sniff it out instantly. Those 10-year and 30-year bond yields. They'll shoot higher, anticipating that money losing value. And when those yields jump...
Mortgage rates shoot right back up with them. Probably fast.
Exactly. Skyrocket's probably the right word. So the window to actually benefit from those QE-induced lower rates could be incredibly short, maybe just a quarter or two. You really can't afford to drag your feet if this forecast plays out. Okay, so now we need to tackle that narrative you hear everywhere, that prices have to crash because nobody can afford these homes. It seems logical, right? But the source material pushes back hard on this. It makes a really compelling point. Just look at places like California or New York City. Homes being wildly unaffordable isn't exactly a new thing.
But wait, how does that work? If wages aren't keeping up for the average person who is buying, it can't just be like tech billionaires everywhere.
Well, the demand, according to these sources, is increasingly being sustained by big institutional capital. They're very blunt about it. They basically say, if individual buyers like you get priced out, institutional buyers step right in. They specifically mention huge firms like BlackRock, saying they will be your new landlord.
Wow.
For them, housing isn't primarily shelter. It's a long-term asset class that performs well against inflation and their ability to buy. It doesn't really care about the median income in your town.
That's a sobering thought. And it kind of leads into the foreclosure data, doesn't it? Foreclosure activity is picking up slightly, and the source uses this uptick to cast some doubt on the whole booming economy, strong labor market story we keep hearing. The implication is pretty clear. Maybe incomes haven't kept up with inflation, and maybe the job market isn't quite as solid as the reports say, forcing some people to miss payments.
Right, and while that rise in foreclosures does support some skepticism, we absolutely have to put it in perspective. Scale matters here. Foreclosures today are nowhere near the levels we saw during the last housing crash. Not even close. To give you an idea, we're currently seeing activity that's still well below what it was back in 2005. That was considered relatively calm before the storm hit. At the peak of that crisis, the number of foreclosures was, many, many times higher than what we're seeing now. And this brings us to a really crucial point from the sources. Let's call it the waiting game warning. If your plan is to sit back and wait for foreclosures to spike high enough to cause a crash, you might be waiting 5 years just to see foreclosures peak. But remember what happened last time. Prices didn't actually bottom out right when foreclosures peaked. home prices didn't hit their absolute lowest point until 2012. That was years after the banking crisis really got going. So you could be looking at a potential 8 or even 9 year wait for the actual market bottom.
8 or 9 years just waiting and losing ground to inflation the whole time, presumably, while the market figures itself out. If you wait that long, it seems likely prices would have already climbed so much more that even if there was some kind of crash, the bottom might still be higher than prices are today.
That's exactly the argument. The source suggests that thinking about buying a home purely as an investment, like a stock or some kind of get-rich-quick thing, is maybe the wrong frame.
Yeah.
It's fundamentally about owning your own long-term assets as a way to protect yourself from, well, monetary inflation, from your money losing purchasing power over time.
Yeah, that inflation protection argument really resonates, especially if you're renting. I heard the story recently, it really stuck with me. A friend's landlord just hiked their rent 40% overright when the lease was up. Justified it by saying market rates changed 40%. When you rent, you're just completely exposed. The landlord passes every property tax hike, every cost increase right onto you. A fixed rate mortgage, even if it's at 6% now, is protection against that kind of future shock. Hashtag tag outro Cole.
So, to kind of wrap up the core dilemma presented in these sources, on one hand, you've got this institutional buying power potentially propping up prices, making a huge crash seem less likely in the immediate future. But on the other hand, you have the strong expectation that the Fed is going to have to resort to massive QE printing trillions, probably starting in 2026. And that action, because of that inflation lag we talked about, is almost guaranteed to eventually push all prices up, including sustained pressure on home prices. Affordability likely gets worse.
Right. So the takeaway from the sources seems to be if you are in a position to buy a home now, doing so could be crucial protection against that coming wave of inflation. The consensus in this material is pretty clear. The underlying housing situation, affordability-wise, is probably going to get worse, not better.
Which leaves us with the final question for you, the listener, to really chew on. Thinking about that long lag we saw last time, 8 or 9 years between the foreclosure peak and the actual price bottom if you decide to wait for a crash this time. How much higher might home prices have already climbed over those next 8 or 9 years before that hypothetical bottom is even reached? What's the real cost of waiting, not just in potential lost equity, but in continued exposure to rising rents and inflation?
Something to definitely mull over. We hope this deep dive into the source data helps you navigate whatever your next move might be. We'll talk again soon.